answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hansen and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Thanks for being part of our program, and you may be listening to this via radio or podcast. And as I was realizing, this is a financial planning program, both myself and my co-host here. We're both financial advisors, and we're going to talk about financial matters. And I realized the radio podcasts tend to be broadcast a little bit differently than radio. Podcast seems it's kind of more kickback, a little more formal, relaxed, like Charlie Rose used to do interviews, just kind of kick back. And so it's kind of funny because I think we have more listeners via podcast now than we have via radio, but we still do this very much like it's a radio program. So
but
bear with us.
On terrestrial radio, you've got spots to hit and certain times in and times out, which actually, by its very nature, means you actually have a less of a free-flowing.
Okay, well, it's
by its very nature, because you have to start conversations and end conversations at certain points in time.
Yes, that is correct.
My only complaint about podcasts, quite frankly, is the ones that run ads, which I don't mind the ads, but don't run the same ad 22 times during your show, the same exact ad. Just go out and get some different advertisers. I don't like hearing the same ad over and over again. That's my biggest complaint. Okay. I could live with the ads because I understand why the ads are there on the podcast.
Thank you, Pat.
These are things that bother.
Okay.
Oh, just be glad you're not in my brain.
We're gonna have a whole list of
things that bother Pat.
Yeah, lamentations of Pat McClain. If that's the kind of thing that life's pretty good. If that's the thing that's keeping anyway. Yeah. Anyway, we're glad you're here as we're talking about financial matters and as we're getting near the end of the year, and we've got a great program. Not only are we going to take some calls. But the second half of the program, we're going to have, we're talking taxes.
Oh, this is important this time of year.
Yeah.
Because there's only certain things that there's certain things you have to do in the year
to get credit for.
There's other things that you can partially do, and there's other things that you could most certainly defer until you file your tax returns.
Yeah. So anyway, we've got the second half of the program. Michael Mouriski, CPA, is going to be joining us. We're going to talk tax stuff. So if that's not exciting.
Well, our own Michael Mouriski from Allworth.
That's right.
CPA extraordinaire. Pretty good.
Yeah, and here it is coming towards Christmas time, and maybe you're out Christmas shopping.
Yes. And
I have not been in any stores shopping, and I don't plan to go into any stores shopping. I don't go to many stores anymore.
Yes.
I go to the grocery store.
I believe many retailers are aware.
They feel that. I don't even go to Costco very much anymore.
You know what's interesting?
We're going to get to the calls and we're going to get to financial
stuff.
The
thing that it actually is surprising me, not that people are using it, it's what I use it for. Like a trip to Home Depot isn't, I'll just wait 2 days and have them deliver some silicone caulking to my house.
I do the same thing.
Right? Before I would get in my car and drive to the Home Depot. I'm like, I'll just wait 2 days and it'll come here.
And I think the reason Amazon is crushing it is because they do such a great job and you're so confident and you don't have to enter your address and your credit card information.
It's
and
easy.
You click OK and then you miss something and it takes out the credit card number. You got to go back and enter it all in again, right? So oftentimes I'm on someone else's website and then I go to see if it's available on Amazon because that's how Amazon's crushing it.
I read a statistic the other day. I was reading about the delivery services. 14% of all packages delivered in New York City are stolen. 14%.
Oh my gosh! No way. 1 out of 7.
That's. I couldn't believe it either. And I thought, how
is that a real study? That sounds like fake news.
Yeah, I read it in the New York Times or the Wall Street Journal, one of the two. 14%. And they talked about how employers are actually having to deal with it because they now will not allow employees to have packages delivered to their workplace. Because you imagine,
I can see, I'm just going to have it sent to work.
And if everyone's doing that, everyone's got.
All right.
Anyway, it's a financial show, so let's get to the finances and take calls.
Yeah, and don't spend so much money on Christmas that it derails other things in your life. To be part of the program, if you want to join us, 833-99-WORTH, 833-99-WORTH will get you onto our program. And we're going to start taking calls out in Colorado, talking with Jack. Jack, you're with Allworth's Money Matters.
Hi there. How you doing?
Good. How you doing, Jack?
I'm good. Got a quick question for you. I've got some. I'm 63 years old. My wife's 70. I've got some investments built up now, but they are between 4 different outfits. And as we get closer to retirement, she's pretty much at retirement now, and I'm getting closer. And I'm wondering, they're all doing okay, but I'm wondering who do I go to, or which one do I take the advice for in terms of, doling it out later on when we're ready for retirement.
Well, let's talk about what they are, and then we'll give you direction as to how to consolidate them. Because if they're stocks or bonds or mutual funds, it's really quite simple to actually just put them all in the same custody.
And maybe without changing any of the investments, you just take the exact same investments and put them all under one umbrella.
Especially if it's after taxes, you want to keep them, if you have large capital gains on them, you may want to keep them intact and not liquidate and buy something new because of the tax implications. So let's start with the first account. Where is it and what is it?
Well, it's with an independent fellow, and it's in growth stocks for the most part.
Okay, individual stocks.
Right, and I take it he goes out and buys the advice from other people, then puts my stocks puts my money into them.
And how do you pay this broker to buy the stocks?
He gets 1.8% per year, I think, commission.
Okay, and where is it custodied? So it will either be custodied at Pershing or Charles.
Ameritrade.
Oh, okay, so it's a TD Ameritrade. All right, so and this is after tax. It's not in an IRA, correct?
Part of it's an IRA.
Okay. So you've got one guy, and how long have you been How long have you been with this advisor?
What's that?
How long have you been working with this advisor?
A couple of years now, I think.
Okay. Are you happy?
Yeah, very happy with his results.
Okay. All right. Where's the next account?
Next one is Allianz. I've been with them a little bit longer, but it's going to be an annuity.
Okay.
They've got a guaranteed no loss, and then they've got a maximum of 5%.
And who sold you this annuity?
What's that?
Who sold it to you?
Yeah, who sold it to you? Where'd you buy it?
There's a local fellow here in town that does this.
It's not the same guy that you have the stocks with, correct?
No,
different
guy.
Okay, where's the third account?
Third account is with Fidelity. That's the smallest amount of money, but it's growing the fastest. It seems like. I hate to put a plug in for him on air, but
and what
they've done very well.
What's
it all depends what it's in, because at Fidelity you could be owning anything.
Yeah, so Fidelity is the custodian. It's what's it invested in.
I couldn't tell you. I'm the kind of guy that hands over the money and says, take care of me.
Okay.
And did you go to
not be the smartest thing, but I don't understand all of it.
Did you go to a retail branch at Fidelity to figure out who picked the investments for you?
The Fidelity was the result of an inheritance, and so it was done before the inheritance happened.
Got it.
How long ago was the inheritance?
How long have I had it?
Yeah.
I've had it for, again, a couple of years, I think.
Okay. And then the fourth?
The fourth one.
And then the fourth one is a UBS, and he mostly just picks stocks.
Okay.
What do you think you should do?
Well, I don't know. I could do hunches and so forth, but, everyone's a fiduciary, it seems.
Except for the Alliance
That's
annuity.
kind of a loose term these days.
It is a loose term.
Good for you.
And the UBS guy is not.
May not be.
The UBS guy I like because he's he's got the good old-fashioned conservative advice, and I appreciate that.
Which
The first one that's held in Ameritrade is he does some pretty good planning out in front and so forth.
who's doing the who's doing the best planning to talk about where to take money for your retirement income and how to deal with what's the taxation on particular funds when you go to withdrawal? And
I'm going to have to give a nod to the person who's doing the TD Ameritrade account, but UBS is pretty close after that.
Is there advice conflicting ever?
Not really, but what I worry sometimes that, well, I think you should take the money out of the other guy's account. That way they get a bigger commission, which I know is not the way it's supposed to work, but
well, it's actually exactly the opposite.
well, it should be.
Yeah,
You should get a discount
right.
as
you should get a discount as the larger the account. So if you took the UBS and the Fidelity and you went over to the guy that was managing the individual stocks,
are there any bonds too? Are there ETFs and that sort of thing?
there are some, not a great deal, but there are some.
You know, I got to tell you, if I were you, if you were my brother, I'd first of all say, why am I not managing your money? Because you would be my brother. But if you were my brother, I would tell you to get rid of the Fidelity and move it to either the TD Ameritrade guy or the UBS.
And the investment to Fidelity might be fine. You might not want to change anything with it, but you don't need that additional
layer. And you could actually just say to the guy, hey, I don't want to pay you on this thing, but can you just custody and keep it there? Or you could say to the guy, put it in the portfolio. I would be more likely to move it to the UBS guy because it sounds like over the phone that he probably has a better diversified portfolio than the individual stock guy. That would be.
So would he take the Fidelity accounts and move them, or would he just keep it all where it is?
He can move them in kind. He can move them in kind, or he can liquidate and move them. You've had them for a few years, so you may have some gain. I don't know how much. You would hope that he would do that analysis.
I'll be honest with you. The Fidelity from the first this year till now is about a 22% gain.
So
but the stock market's up greater than that.
So what we know is that
maybe the TD guy's not doing a very good job for you. The guy that's using TD for holding your account.
Yeah, it depends.
If he's mostly stock,
about 10.
And is he all stock or half stock or
the TD guy?
Yeah.
I couldn't say exactly what they're in. I just think of them as growth stocks.
Got it. So the problem is
if he's all in growth stocks and he's only up 10% for 2019,
he's not doing well.
No.
So the problem is you can't compare these portfolios to each other without actually knowing what's inside them, because the one that's at 22%, I guarantee you it's either 90 or 100% in stock, and the guy at UBS and the guy at TD may have something that's more appropriate for your situation. It could be 50 or 60% in stock. So you comparing returns and not risk, it's not fair. It's comparing apples and tires. They have nothing to do with each other. So the question you had is, can you consolidate? Yes, you could. The one that I would consolidate is the Fidelity, and I would do it in kind, probably in kind, or at least talk to one of these two gentlemen.
And have that advisor manage that Allianz annuity for you as well.
Yeah, because inside of it is probably got some investments in there. Whether you should have bought the Allianz annuity or not is questionable, but you have. But I would bring that annuity into someone and say, I don't want to move this because it probably still has a surrender charge on it. How long have you owned it?
Oh, we've had that for probably 10 years.
All right, well, bring it in.
It's got a surrender charge.
It still has a surrender charge.
Yeah. It does.
After 10 years. Wow. That's steep. Have the investment advisor, one of these guys, look at it. Or you could split it half and half. You could take that Fidelity and give it half to the individual guy and half to the UBS guy. But I don't think bringing it down from 4 to 2 would be.
It's better.
Yeah, it's better. And that's what
and you can still own like the Fidelity funds you've got, whatever you've got at Fidelity. You don't need to liquidate those if they're good investments.
You can bring them when you transfer them in kind, they stay intact.
And there's a chance that the advisor will, if you're still holding them and he's not providing any advice, won't even charge you to house them there.
Yeah, they're just going to do it as a courtesy.
And it's just one less relationship to deal with.
Yeah. And
Exactly. That's a good thing.
have one of these guys look at that annuity. Don't let them sell you a new one.
No.
Don't let them sell you a new one. But you may want to get out of that annuity depending upon the guarantees, or you may decide to keep it. But I'd actually bring that annuity to both of them, and I'd have them give them opinions on the annuity. And you know what they're made of.
Yeah.
All right.
All righty?
I can do that.
Yeah.
Appreciate
All right,
the
glad
call,
you
Jack.
called, Jack.
Thank you kindly.
Thanks.
All right. Thanks for being a listener of.
What a nice, it seemed like a
Allworth
nice
Money.
man. I think that about everyone, though.
He seems like a nice guy. He seems like a nice enough guy.
Actually, that's why I'm so bad when interview. You're just as well when you interview people for the company.
Oh, I can't interview.
I like everyone. I like most people, and I'm like, they seem like a great guy. And then the human resources, they have absolutely no experience. I'm like, well, there's that.
Well, there's a lot of things I don't know how to really judge for because I don't understand some of the roles in the organization.
Yeah, that's why they don't let us make most of the hiring decisions around here.
Well, we have help.
We
People
do.
that are better at that than
Yes,
I might be.
fortunately.
Yeah. All right. To join Allworth's Money Matters, you want to call the program. I'd love to hear from you. 833-99-WORTH. We are in Lodi, California. And I think Lodi has more grapes per capita than just about anywhere in the country.
I lived in Lodi for a year once.
Terry, you're with Allworth Money Matters.
Yes, good morning.
Hi.
I was calling for one reason, and then I think I answered my own question. So I've got another question. I was initially going to ask about the spousal SSI because your understanding of it challenged what I understood. And then I recalled something happened about 3 or 4 years ago for people born after 1955, which changed that.
Yeah.
So
There's a big loophole that they shut down, essentially.
Yeah. Okay. So that's no longer my question. My question is going to be, I'm 64 years old. I've been retired for about 2 years. I had pretty much most of my retirement money in my IRAs and as well as in some brokerage investment firms. And then earlier this year, I went out and bought 2 rental investment properties and put the 20% down for conventional loans and have solid renters in them that covering the expenses, the PITI, as well as I build in about a 4.5% return on the monthly mortgage that they're paying.
All right.
What I was questioning was, would it make any sense to pay both those houses off with my retirement funds money, take 25 or 30% more out than I need, pay the taxes, and then have both the rental investments paid off?
Maybe. How much do you have in your IRA?
I've got in my personal IRA about $750,000, of which there's some of it's about $450 is managed by a investment firm, and I manage about $300 in myself. I also have about $1.2 million from my former employer's 403B, which is in a 3.5% fixed fund, no fees.
Okay.
My brokerage account, I've got about, which is the after-tax non-qualified money, about $250,000 in it now after I've liquidated it down about $200,000. It started out about $450,000. I bought 2 roughly $400,000 homes, paid $100,000 of equity into it, so I'm left with 2 loans of about $300,000.
And how is the brokerage invested?
The brokerage is invested in my Schwab account. About the $250,000 that's still in it is about $100,000 is in laddered CDs, and about $150,000 is in equities and electronic traded exchange funds, the different sectors.
And what is the interest rate on the mortgage of the rentals?
One is 3.5%. The other is 3.625.
That's amazing.
And is your home paid for?
Are these 30-year or 15-year mortgages?
They're 30-year. My home is paid for. It's about a market value about $600,000.
And you were able to get non-owner occupied
80% financing at
20% down, a sub 4% guaranteed for 30 years.
Unbelievable.
Yes.
Good job.
And Well, thank you. I will put the caveat. I've got two sons that are living in them. One of their so they're
Okay.
quasi family homes. Except
We're laughing
and
with
they-
you, not
they
at you,
do-
by the way. We have kids.
Okay, and they do. They're like all millennials. They have a lot of cash flow money, but nothing saved.
Mm-hmm.
So the money, I made the down payment. They've got a long-term payment plan back to me if ever.
Got it.
And they pay the mortgage, and within the mortgage and the insurance and taxes, et cetera, I built in about 4.5% of margin for myself.
Okay.
And at some point in
Taking it-
time, do you think that you would sell them these homes
That's kind of the plan.
at a reduced
Right now-
price or something like that in the future?
Perhaps. Right now, the way the titles read is my wife and I in our trust, we own 99% of both homes, and they each own 1%.
You're really good at this, by the way. You really are. You're an exceptional investor, and what a great saver to see an account balance in a 403B of 1.2. And either, for the rest of the listeners, Terry either worked at a school or probably a hospital, and maybe a nonprofit.
Correct.
But
And
it was probably a
are
hospital.
you taking any income from your 403B or IRA?
I take $78,000 a year from it to keep me in my 12% tax bracket, and the rest I pull from my brokerage.
Have you
account.
considered having some go to Roth conversion instead?
I started that just this last year, and I put I've got 7,000 in it now, so I think
No.
I put.
Let's here's one thing to think about for the next year, 2020. If you took let's say you didn't let's say you took out that 70,000, whatever the number was, and instead of taking it out, you just simply converted it to a Roth, and then lived on your laddered CDs for a period of time.
Are you on Social Security yet?
I'm not. I was going to wait till 70. My wife is taking it now. She started taking it at 63, and her payment's about $2,000 a month.
What about taking a spousal benefit?
You.
Well, that was going to be my question. Except we were both born in 1955, and they ended.
Oh, no, they
That's
didn't
the
end that.
spouse that did this.
They had file and suspend is what they ended. That's where you would file, and then the
Pretend like
spouse
you
would,
didn't sign.
and then the spouse would file on a spousal benefit, and then you would suspend yours, so yours started accumulating again. They got rid of that. They didn't get rid of
Spousal benefit.
the spousal benefit.
You
So-
said I want to sign up for my spousal benefit.
So-
not my own, just my spousal.
So the question you called with, which by the way is financial planning, it has a tendency to open a can of worms as we have these conversations because we run into these things. The question you called to ask about, does it make sense to pay down the mortgage?
I would say no
Probably not.
for two reasons.
One is that it makes more sense for you to actually, I would do, if you were sitting in my office, I would say three things. One, file for the Social Security benefit, a spousal benefit, and then look at doing a Roth conversion,
Rather than taking the money out.
especially between now and the next couple of years, and then live on that brokerage account for some or all of it.
And the part of the reason of not the challenge is you're getting 3.5% on this fixed annuity inside the 403B, and your mortgage rate's slightly higher. The challenge is that those dollars haven't been taxed yet. So the idea of taking a bunch of those dollars out and paying taxes on it for an interest rate that's so low, it just doesn't.
It doesn't sit well. And
Yeah.
And by the way, you have plenty of other assets.
These aren't pure investments. These two rentals are not pure investments. Your sons are living in there, and there's a good chance in the next 10, 15 years, those homes are going to be not yours, they're going to be theirs.
And the debt that goes along with it. So the reality is you may not have bought those homes if your sons weren't going to actually move into them.
Correct.
So it's not an investment. You're just trying to make
I like that. They're paying the mortgage. Let them keep paying the mortgage. If there's no mortgage, who knows? They might not send you that check that month because, come on, Dad, there's no mortgage.
Yeah.
Okay.
Right.
Hey, could I ask you that now that you've brought it back up again about that SSI? So my wife gets paid the $2,000 a month. My statement that I get annually says that, when I'm 66, which will be in 2 years, I'll get like 3,100, and if I wait till 70, I get like 4,000.
Yeah, you're going to wait till age 70.
Right. So what my wife's getting her 2,000 now. What does she get? She files.
She's already filed. You'll get 50% of what her benefit would have been had she waited till age 66 and almost 67, full retirement age. You'll get probably about $800 a month.
I know, but Scott, wouldn't it make sense for her to actually suspend and him to actually start Social Security and her to take the spousal benefit? And in fact, it may make more sense for her to actually pay back everything she's received, depending upon how long she's taken it.
Hey, well, we're up against.
But this is what we do know, is that there's an answer there somewhere.
It's just going to take a little more planning.
And then this phone call is going to allow. But I would look at whether she should suspend completely, maybe even pay back. You start it, yours, and then hers.
You need to do some analysis.
And I do the analysis.
You need to do some analysis around here. But you're thinking the right way, Terry. You really are.
Great saver.
We're going to take a quick break. Stick around for more Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
And this second part of our program here today, we are not taking calls. But actually, if you'd like, if you're thinking, I would like to call us, guys, call the number anyway, and we'll schedule time to take your call at a future time. But we've got, we're going to talk taxes. End of the year.
Exciting. Necessary, but exciting.
Your taxes are exciting?
No. But they're necessary. It's the degree in which they charge them is probably unnecessary.
That's subjective.
Well, that's obviously, because there are many people that would like to see the tax rates
go up. Yes. Just
Many.
listen to particularly the current presidential debates.
Yes, they tax the wealthy.
And
if you think that, listen, you can think whatever you want, but we live in the state of California, and Scott and I have many friends that own businesses, and many of them are leaving the state of California.
Charles Schwab announced they're moving their headquarters from San Francisco to Dallas.
Yep.
Just outside of Dallas.
Yep.
How many companies did they say left California? I forget.
Because you know why they do? Because they can. The bigger, the better, the more robust an individual's financial circumstance or a company's, the easier it is for them to actually relocate. Not the other way around.
Did you see in the news recently that Amazon just leased a bunch of space in New York City?
Which was hard to believe.
Well, see, they're trying to go. They do this whole process saying they went for tax subsidies. New York came with these tax subsidies. They said they're going to choose New York, or was it Brooklyn? I forget. Maybe it was Brooklyn. And then some other people said this is ridiculous, and so it fell apart. And now they're leasing a ton of space anyway in New York City. Just kind of makes you wonder.
What happened there?
If some of these handouts.
But tax rates are certainly are important. There are ways to mitigate much of.
And you're talking about companies leaving the state of California, the state of New York, the state of Connecticut. Individuals are leaving. It's
who leaves? The people that pay the taxes. What's that leave? A smaller pool.
You look at Connecticut.
Taxes. Oh, the hedge funds and out of Ridgefield.
What's the town that they're all leaving?
Yeah.
The real estate prices have plummeted. You can get a phenomenal mansion for half the price what it was 5 years ago.
Yeah.
Very wealthy enclave.
There's too many. I've been back there in Connecticut. Too many trees. There's just way too many trees.
It's quite beautiful, actually.
You drive down the road, all you see is trees.
What would you rather see?
Like rolling vistas and plains and some trees, but not just trees.
Like dead grass, California hills, right?
Kind of, a little
The
bit.
Golden Hills.
Okay, but now.
Anyway, so we're going to talk tax stuff, and we've got on for the program Michael Mouriski. Michael is a CPA, and he heads up Allworth's tax division. So, Michael, welcome to Allworth's Money Matters.
Thank you. Happy to be here.
Thank you, and thanks for being part of
The Allworth team.
and heading up and we have a tax division that not only does tax filings for people, helps with the compliance, making sure their taxes forms are done and that sort of stuff, but tax planning as well. And he heads up
and works with our advisors on tax planning.
Yeah, his team does. Yeah,
certain clients.
Make sure we got the right kind of tax planning going on,
which is a vitally important part of the financial planning process.
And so Michael's joined us to talk about some taxes, and we're going to have this kind of free flowing and let it go in a variety of different directions because we all have different tax situations. And so, Michael, just starting off, what do you see are some of the, and someone might have given Michael these are the questions we're going to ask, and we're not going to stick to the script. I apologize.
Of course not.
But Michael's been working with us long enough.
Did someone give you a list of questions we might ask or will ask?
Yes.
Oh, okay. Do we have that list?
You got the email on it a week or two ago.
I didn't read it.
But I was warned that you would. I was warned that you might.
What?
You might go off the list.
What?
Oh, since I never read the list.
What? How would you know? What are those most common mistakes that you see that individuals make when it comes to taxes? Like, what are the obvious ones that you see that you kind of like? You kind of cringe at. Think these are the more common ones.
Sure. So, and most of these, frankly, are from people that prepare their own taxes. Although you do see mistakes from professionally prepared returns. But oftentimes, for someone that might have a rental property, they'll not take depreciation on their rental property. They, of course, will just miss entering in income on their returns. I've seen mortgage interest be doubled or duplicated, some of it as an itemized deduction, again, as a rental, various things like that.
If someone has a rental property, should they file their own tax return or should they get professional help? I guess that depends on the quality of the person filing the taxes.
Exactly. I mean, like I said, it is easy. If you don't know what you're doing, I've never used TurboTax. I understand it asks you questions, but certainly if you don't know what you're doing, you don't know what you're missing, right? So, example is depreciation. A lot of people don't even know what that is. So that's something that's missed quite often. So I would recommend, if you have a rental or you're, backing up, if you're thinking about having a rental, you should do some tax planning around that and understand what it will mean. Oftentimes, I've had clients come to me and they say, "Oh, I got a rental. I can't wait to get all these extra deductions this year." And there are limitations based on your income.
Yeah.
Whether you can take rental losses, and a lot of people get surprised when they're not able to take rental losses.
And is that phased out? Is that $125,000 when it phases out? What's the limit? $150,000. So if your income exceeds $150,000, a married couple, and you have a rental property, you're not going to be able to claim any losses at that particular time.
If you have net losses, correct.
Yeah. Yep. You got to. So.
They get suspended and carried forward.
Carried forward in the future for when you sell, assuming you have some gain in the future. And
the whole bit.
That's right.
Yeah.
So
that's the whole plan. Yeah.
That's the plan.
Yes.
To get a gain on the rental?
Some gain down the road. Right?
Let me write that down.
But and I see this fairly often where people have bought a second home because their tax preparer told them that they needed more deductions, and which is
I had a client come in. She was widowed. And her sister came with her, and her sister, I guess, help her or whatever. And her sister said, "Well, you need to get a rental because you're paying too much in taxes." And this lady was just widowed. And I'm thinking,
that's the last thing you need.
Right.
It's correct.
Maybe her tax bill would be slightly less, but how is that going to make her life better?
Yeah. So you should never let the tax strategy drive the investment strategy. It should be part of, correct?
Absolutely, and you should also not let these decisions, be driven always by tax. A lot of people will think, should I do this because it's better for tax purposes? And sometimes it's, well, what do you want to do, right? Should you buy or lease a vehicle? A lot of people ask me, oh, yeah, I've heard I should lease a vehicle for business purposes. Well, if you're typically someone who drives their car a large number of miles and you like to hold on to it for 5, 7, 8 years, well, you're not a leasing type person. So no, you shouldn't lease just because it might be better for tax purposes if you're really not suitable for leasing.
I agree.
So we're near the end of the year. That's why we're having part of the reason to have it. We've had changes in our deductions, itemized deductions, where we're limited now to $10,000 for state and local taxes.
Correct.
What are some planning things that you see people are doing, or you guys recommending with this new limitation?
Well, one of them is what some people will refer to as a bunching strategy. So, again, and I also want to point out too, there's looking at this from the federal perspective, and there's looking at it from, primarily for me, California, where most of our clients are. But if you're in a different state, you want to be aware of, if there's any differences there versus the federal. But taking the standard deduction one year and trying to bunch your deductions and itemizing in the off year and kind of doing every other year strategy, that's worked well for some clients. And whether it's for taxes or for charitable contributions or even for medical, trying to alternate years so that you have a much higher itemized deduction amount in one year, and then the next year you take the free amount, right, the larger standard deduction.
Hey, and speaking about charity, do most people get their charitable giving wrong? Are they not doing it the most efficient way they can? I guess that's a leading question because I have an opinion about it.
Well, I think it depends on how you look at it. I mean, there are a number of clients that, again, for federal purposes now, a lot of their charitable giving is really not helping them for tax purposes because they're taking the standard deduction.
Yes.
So that's one.
And what percentage? What percentage now are standard deduction? 92%, 93% of Americans, something like that.
It's significant. Yeah. I mean, it's I would, for our practice, I'd probably say maybe 75%.
And that's your practice.
Your practice,
Yes.
right? Those are some people that, wow.
These aren't people that are on, living in subsidized housing.
Which are
Yeah.
So these are savers.
But I would also say that, just to be clear too, that's on, oftentimes you're taking the standard deduction for federal, but you're still itemizing for California. So that's one of those things to keep in mind before year end is, don't ignore the charity and, what you'd pay for DMV for your licensing, these things that you would typically use, or job expenses, which are no longer deductible for federal, but they still are. At least for California, don't ignore all that. You still should kind of, as I call it, business as usual when you're gathering all your typical deductions. Don't ignore all that just because you might take the standard deduction for federal because those items may help you for state purposes.
But when I was talking about charitable giving, using the charitable required minimum distributions for qualified charitable distributions instead of coming out of pocket, or people gifting appreciated assets, stocks, bonds, mutual funds, or real property. Do many people kind of miss that?
Yes, I think the self-preparers and those that really aren't using someone to help them on the financial planning side often aren't aware of those options. So yes, it is missed.
So if someone sits down with you and you do your tax return, do you have a conversation, or someone in the tax division have a conversation with the client saying, look, this is what you did last year. This is what I think you should do this year, and kind of give them bullet points to hit?
Yes, exactly. Yep. We always, especially if it's a new client, we go over the last 1 or 2 years returns to see what they've done, ensure that it doesn't look like anything was incorrect, and to see what they took advantage of or what they missed. And, if we're talking to someone right now, for example, there still might be time before the end of the year to act. And if not, it'd be a planning piece for the following year.
And will you? How often do you have to go back and refile someone's tax returns that it was that far off? And how many years back can you go?
Well, usually 2 to 3 years you can go back, just depending on the time. The IRS has a 3-year statute, and California has a 4-year statute for when the returns are still considered open, and you can amend them. I would say it's not a large number, but every now and then you'll find someone where it's a significant enough mistake. I mean, I probably have a handful every year where we'll go back and amend at least 1 or 2 years because it's worth enough to them to do it.
And those are typically coming from other preparers or people doing their own taxes, or both?
Both. Yeah.
And Pat and I were talking before you came on about people leaving the state of California or other states and going to tax-free states. And I'm certain that you probably counseled some people on what they need to be aware of in when they switching tax residencies. So tell us about let's say someone's lived their entire life in California and saved in their IRAs. Now it's retirement stage. They want to go live in Nevada, live in Texas, live in Florida, or a handful of the other states where it's no income
either
tax.
low or no income taxes.
What do they need to be aware of with the franchise tax board
And
to
have
make
you
sure
ever-
they're in compliance?
Have you ever represented anyone that was out of state where the state was going after their income?
I have not. Typically, it's really my understanding is, at least for California, is unless your income is around $1 million, the residency audits, usually don't go much lower than that from an income perspective.
Okay.
So I haven't had anyone deal with that. I would even back up. I mean, the first thing I would mention to the client or the taxpayers is, again, don't let taxes drive the decision. First, do you really want to leave, right? Do you have family, friends here, or so don't forget taxes for a minute. Don't leave just because of taxes if you really don't want to leave California. But if they are, really thinking about it, number one, your income taxes might go down, but what are the other taxes in that state, right? Are property taxes higher, or are the sales taxes higher? So you don't want to just leave one tax and pick it up with
somewhere
another
else,
tax.
right? Yeah.
Yeah, exactly. You want to make sure that if you're moving to reduce your overall tax burden, that's really going to happen.
Yeah.
And then specifically for clients that want to move to Nevada, and maybe they're going to have a second home, and maybe they're really not moving, but they want to say they live in Nevada. My counsel to them is, the more that you can do to prove that, you really live in Nevada, whether you're voting, your driver's license, because when they do these audits, they will actually look at phone records. They'll look at where you see your doctor. They might look at credit card receipts to see where you get gas.
They're looking at your cell phone records, correct, to find out what tower they're pinging off of.
Exactly. Yeah.
Right.
So the more that you can really move to where you say you're living, the better.
You have to be there. You have to be there.
Yes.
You can't just use this as a way station for you leaving vacation.
It's interesting, Michael. So
That's right.
You talk about don't just do it just for the taxes, or so. There's a few years back. There's an increase. The voters voted to increase the top tax rates for the top tax rates in California, and I remember I was just like, I'm thinking
for mental health.
No, that was the years before, but then there's another one. The last whatever year it was, I forget, a few years back, and I remember that. That's it. I'm thinking that's it. I'm leaving. I'm gonna, as soon as my kids are out of the house, I'm gonna move. I'll figure out how to just work remotely.
How'd your wife feel about this?
So I remember. So I started doing some pretty good planning. I'm talking to the accountant and all this stuff, and looking through the whole how much it's going to save me. And then my wife and I having this conversation, and she says, "Well, first she's like, we've lived here in this community for 20 some odd, almost 30 years. I love living here." She says, "Can we not afford to live here any longer?" And I said, "No, we're fine. We can live here." well, didn't you? She says, haven't you worked hard to give us so we have some freedoms and can live where we want to live and those sort of things? I said, yeah. She says, then why do you want to move? Why do you want to move?
What's your wife using the logic on you for?
And it's interesting because when I really kind of got down and started thinking about it, she was right. And we've had clients that have left California, moved to Texas
or Nevada,
Utah. I can think of just thinking of the families, right? And come back.
Right?
Yes.
And come back. So oftentimes when we are counseling someone, we obviously will use our tax services, but our advisors will have the conversation that is on a more emotional level. Why are you doing this? What's the draw? If the draw is only for taxes and not another reason, such as climate or family, you may be making a mistake. And oh, by the way, to minimize the mistake, why don't you rent for a year where you're going to live? Or most certainly, go and spend a number of weeks in all the seasons there to understand it. You had that one client that moved to, Montana or Wyoming and was going to live there year round. And after 2 years, the wife's like, you can live here as long as you want, but I am not spending another winter in Wyoming.
They did stay there, though, for years.
And then they ended up moving, though, did they not?
No.
Really?
If you're thinking of the same client I'm thinking of.
Yeah.
No.
The guy you went fly fishing with, and the only thing he brought was beer. You were out for like 8 hours.
I got to tell you, it's not, yeah. This is a quick side story here. I went to visit we'll call him Jim, because that's his name. No, I'm kidding. So I went out and visited him and lived in the middle of nowhere in Wyoming. Wyoming.
Okay.
No, Montana. And he invited me to come stay with his family, which is always a little awkward.
It's all like those commercials where you see the advisor going to the guy's wedding.
That's
you were like that.
And
you got to be friends with him.
Yeah. But he was a huge fly fisherman, so he invited me fly fishing. That's why I went out there. So I don't fish at all. I don't know what I'm doing, right? But I thought this would be an interesting experience. Why not? So we get up in the morning, and you're at someone's house. So it's kind of like you're not really asking for anything. Fortunately, there was coffee and a little small breakfast. But no, there wasn't any breakfast. There was just coffee. And then we started getting in the car, and I'm thinking, well, sure, they were going to stop somewhere. Maybe there's a corner gas station or something where they sell something. And we don't stop anywhere. And we get to where we're dropping the float boat in. We're floating down this river.
Okay.
And I said, hey, Jim, is there like any lunch or anything today? And he says, oh, and he uses a bit of a swear word. Oh. And he forgot to get the food. And so we had 6 Coors Lights between us. That was our total fluid and caloric intake for about 7 hours.
Is that right?
I had the worst headache.
No, did you catch anything?
Yeah,
A buzz?
Yeah. 3 Coors Lights over 6 hours. You're not catching a buzz, Pat. I don't.
Okay.
It's not even. Anyway, that's a total side story.
So, but the point being is, back to you, Michael. You are the guest on the show.
We're fly fishing.
You are the guest on the show.
It was fun though. I had fun. I think about it.
We're back to Michael.
Okay.
Don't let the tax drive the decision. Make it part of the decision-making process, right?
Exactly.
What about the enterprise zones? This last tax bill, you're going to get some great tax deduction, eliminate your capital gains if you invest in these enterprise zones.
Are people doing it?
Not that I know.
Okay, that's
I don't
read
know that
about
I've been asked. Yeah, I mean, you read about them, but I think they're probably larger transactions, and I haven't had one person ask me about it.
Yeah, and many of the things that actually were in the enterprise zone were actually in flight prior to the tax.
Let me ask you this, Michael. So, as in looking at taxes, when you're doing tax planning, you're trying to pay attention to both current year's tax liability as well as future year's tax liability. And sometimes you're just making an educated guess because nobody knows what future taxes are going to be. But in your planning, when you're looking 10 or 20 years out, what are your thoughts as far as taxation and, with overall tax rates, taxation of retirement accounts, taxation of Roth accounts?
Will there ever be a flat tax? Is it going to be a VAT tax? Is it going to be
what do you think
a
about
national sales tax?
Well, as much as I think a flat tax or sales tax makes sense. That's probably why it will never happen, because it makes too much sense.
Well, and it's regressive.
Yes.
It's for the rest of the listeners, what that means is the higher the income, if you have some sort of consumable tax, the lower the portion of tax, the lower the income tax rate will go for those higher incomes because they don't consume all of their income.
Correct. Exactly.
That's why it's called a regressive tax. Versus our tax today is relatively progressive, which is the higher the income tax.
Okay, let's let Michael talk about the.
I'm explaining the difference between regressive and progressive taxes.
I want to hear Michael's perspective.
I'm learning here from Pat.
Oh, yeah. Thanks, Michael. All right. Well, you could quit insulting me and answer the question.
So, first of all, when we're doing projections, normally it's, 3 to 5 years. It's every now and then you might do a 10-year. You're normally not looking out that far. But even if you're doing 3 to 5 years, it's under the premise that, well, these are the rates as we know today, and that could change tomorrow, right? So everything is based on a set of assumptions. At least in my opinion, I don't expect rates to go down from where they are. I think they're going to go back up. Will they go back up to where they are pre this current tax act? I don't know. That's probably a safe bet. So when you're kind of looking at in the future, it's, your personal opinion of where you think the rates will be. That's one thing. And then with the longer projections, you're also projecting out, if you're pre-retirement or pre-70 and a half, you're really trying to figure out what do you think your required distributions will be once you hit 70 and a half. And that really, in some degree drives your tax plan today, because you can kind of look at, well, what income bracket do I think I'll be in at that point, and that will drive some decisions today. Should I accelerate some income? If I think I'm at a lower bracket today, maybe I should do some conversions today, which will also reduce that RMD at age 70 and a half.
Yeah. Well, we're about out of time, Michael.
So a couple of things that people should do prior to a couple of things people should do prior to the end of the year is to see if they should make charitable contributions before the end of the year, pay income taxes.
Yeah, because
to the state.
If they live in a state where there's state income taxes, they very well might be still itemized.
Yeah,
on
and
their
so
state returns.
if they're itemizing, they most certainly should do that. We appreciate you being on the show. Unfortunately, we're out of time.
That's right. But you can learn more about the tax division of Allworth at allworthfinancial.com. And we'll see you next week. This has been Allworth's Money Matters from Scott Hansen and Pat McLean.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.